All right, everybody, welcome back to the channel. It's Millennial Trade. So let's get a look ahead at this market. Let's just look at some of the events that are coming up this week and some of the things I'm going to be keeping my eyes on because we have interest rate hikes to worry about coming up here in December. We also have the inflation data. We have some inflation data coming out on Thursday, I believe. So I'm looking at the markets. I'm looking at the futures, actually. Futures have gapped down both on the NASDAQ and the S&P 500, right? We have the NASDAQ is down about 0.35%. Same thing with the S&P 500, about 0.3%, and they have gapped down. So if we stay gapped down, if we kind of stay lower, at least until tomorrow morning, I think my PayPal puts, the $79 puts that expire on December 2nd, which is Friday, I think those puts are going to be looking pretty good tomorrow morning, but we'll see how it goes. This is probably one of those trades where I should probably just hold it until Tuesday, maybe Wednesday, right? Hold these contracts. And it's probably one of those trades where if I did that, I could probably make like 10 grand, right? Because I have 9 contracts, and if they all went to, I don't know, $500, $600, $700 or something, you know, it adds up, right? It's a lot of money. But I'll probably be in a little bit of profit tomorrow morning, you know, maybe a few $100s, $500. I'll be like, all right, I'm going to take it. I'll watch it go down further, and I'll be, you know, trying to scalp it all the way down. That's sometimes how things work out, because I don't really like to hold, especially if I'm up a decent amount. I don't like to just sit there and take the chance. So, but this little overnight trade that I put on Friday, and I told you guys about this, or I put on, Friday. Told you guys about this on Friday. And I might have mentioned it in my video earlier today, but we'll just see how it plays out. I'll let you guys know either way if we're up or down on the trade. But yeah, the futures gapping down like that, it's a pretty good sign for my trade, at least in the short term. A couple of things real quick. Market-wise, we talked about China cutting their RRR. Basically, the Central Bank of China and is saying that the banks do not have to hold as much cash requirements, right? I think they cut their RRR by 25 basis points. That stands for the reserve requirement ratio. And they do this in the United States, right? Banks in the United States are permitted by the Fed to lend out more money than they actually have, to not keep as much cash reserves. But then they set up all of these, they call them, I guess, facilities, cash reserve facilities that they can sort of back the banks up with, you know, because the banks trade money overnight. They'll lend each other money overnight, and this is there's an interest rate, an overnight interest rate for that as well. But China cutting the RRR by 25 basis points. The reason this is important is because this is exactly what happened in the last financial meltdown of 2008. You know, you had yield curve inversions, you had China cutting the RRR by 25 basis points. So it's just another economic indicator possibly telling us that you know, we're going into deep recession, that we're going to have another kind of 2008 style crash across all the markets. And we've already seen it in stocks, in crypto. Now we're starting to see it in housing. Okay, EU natural gas continues to go up. I guess that warm spell is over with. I'm hearing from different countries in the EU that it is getting colder. Their natural gas prices are going up, and the gain, I guess, last week was 8%, an 8% move in natural gas prices last week. So cold weather is approaching. Supplies remain scarce. You have this whole situation in the Ukraine that I don't want to get into in this video, but there is a lot going on in the world geopolitically. We have to be open to the idea that at any point in time, we could have a black swan event and, you know, it just destroys all these markets. We have to be open to that idea. I don't believe that's going to happen, but we have to at least be open to that idea. So some of the things I'm looking at, these layoffs, right? Twitter cutting more employees. We're going to get back to the Fed and the rate hikes and all of that in a minute. But I found this article here. This is the headline. I'm a 56-year-old IT worker who got laid off last year, and I've been unemployed ever since. I have a hunch I'm not finding work due to ageism. How do I prove it? And this is probably true, okay? There are a lot of people, especially on the West Coast, that were coders a few years ago, 5 years ago, 10 years ago, that find themselves kind of like some of the teachers, sleeping in vans, sleeping in trailers, and this is like a reality. You've got a lot of these big tech companies that were overhiring, that we were in low interest rate, artificially low interest rate environments, just mass liquidity from the central banking systems. And so these big tech companies were able to essentially overhire. I mean, you had these really weird, confused people from Twitter that were like the moderators that were responsible essentially for banning Americans, censoring Americans off of the platform. And a lot of these are the kind of people that are getting fired from Twitter. But they're like the San Francisco News is doing stories about them, trying to, I guess, paint them out to be these victims of Elon Musk and all these staff cuts he had to make. Well, we're in these high interest rate environments. Elon Musk obviously probably paid a lot of money for Twitter. Maybe he turns Twitter into something really, really huge. But that $44 billion, a lot of people are saying that was an expensive deal for Elon Musk. But all of these IT workers, these coders, it really is a bad situation. We have tens of thousands of people now from that industry, and there's probably more coming. You also have the speculation that Tesla's growth is really going to slow, that maybe the company might even contract. There's a lot of competition, all right, from the more traditional car companies that are also producing electric vehicles now. And so the situation at Tesla is starting to look a little precarious as well. And all of this is going to affect the markets. And then when the earnings come out next year, right, we'll talk about the 2023 earnings. If it is abysmal, which a lot of people are predicting, they're predicting that the Fed really can't do anything about it, even if the Fed pivots in December and starts lowering the interest rates, which isn't going to happen. But even if they do, there's not a chance that that's going to now stop the abysmal earnings that we're probably facing, most likely facing coming up in 2023. But from Investopedia, what to expect in the markets this week? We were a little bit up in the holiday trading week. Monday is Cyber Monday, right? We had Black Friday weekend. Well, Monday tomorrow is Cyber Monday. So I'm interested to see when we do get these retail numbers from Black Friday and Cyber Monday. I'm interested to see, is it going to be a good year, right? They're predicting that Americans are going to spend even more money than they did last year. And they claim that, consumers are confident. They're confident, and despite higher prices, they're feeling optimistic, is what this article says. With households of every income level surveyed planning to spend the same amount or more this holiday season than they did last year. And how are they doing it, right? It's a really good question. Wages have gone up, but they haven't gone up that much. The stimulus is gone. All that I can really think of is credit or debt, right? The media and the banks like to call it credit, but it's actually debt. And are people going further and further into debt? Hopefully not, but borrowing is surging. I had this other headline where it talked about talked basically about how, borrowing surge makes quick end to rate hikes unlikely. All right. We have some earnings this week. The one that I'm particularly interested in, we have Salesforce earnings, T-Bank earnings, Dollar General, but the one I'm particularly interested in is Kroger, because I hold Kroger shares and I probably will be checking up on that. We also have some employment information, payroll information coming out, employment reports. We have home pricing indexes as well. And then, like I said, on Thursday, we had the personal consumption expenditures index. This is another inflation metric. I don't know if I'll be trading this exactly because this isn't like the CPI. The CPI is a much I don't know, more profound number as far as its effect on the markets. But the personal consumption expenditures index, there might be a trade there, right? Depending on how you think that's going to come in, cooler, hotter, about the same. You know, you could potentially trade this type of market event. So yeah, labor market in the spotlight. All right. The next thing I want to go over here is from Jim Chanos. All right. This big short seller. He talks about crypto, and he talks about the S&P 500 possibly plunging another 50% from current levels. This is absolutely crazy. And he also says that Tesla's growth will slow. One thing that I found interesting about the whole crypto thing that Chanos talks about here is that, you know, in these bull markets, when everybody's making money, nobody really cares about the fraud, right? Even if there is fraud, as long as they're making money, as long as the customers are making money, nobody really cares. But it's in the bear markets, Chanos explains, that is when the fraud gets exposed. When people start losing money, somebody's got to be held responsible, right? And that's when, I think Warren Buffett's quote is, when the tide goes out, you see who's standing there naked. This is his quote. Typically, fraud thrives in a bull market. When markets turn down and people become a little bit more leery, since most fraud requires new capital to keep going, they tend to get exposed. Madoff in December of 2008 is a good example of that. Enron is also in that class. In this cycle, I think crypto is probably going to be right up there. You know, is cryptocurrency possibly just the whole entire thing one big Ponzi scheme, one big fraud, one big scam that you know, Americans and people of the world are going to kind of turn away from? I don't know, but that's what people like Chanos are claiming. I don't even know if I don't think he's bullish on Bitcoin at all. He says, regulators are archaeologists, not detectives. Asset prices are both the staunchest defense attorney and the harshest prosecutor for financial fraud. Nobody's out looking to bring the bad guys in when everybody's making money. It's only when people start losing money that you begin to get a public outcry, you know, to throw those rascals in jail. And I do think the crypto market perhaps is kind of suffering from this right now, right? When Bitcoin was at 65,000, nobody cared that FTX or Sam Bankman-Fried was trading with customer deposits, right? It was just, you know, whatever. But now that Bitcoin's lost, I think 65% year to date, you know, these are huge issues. And then this short seller Chanos goes on to talk about Tesla has, you know, maybe a tough time coming up here. He talks about that. You know, he doesn't think Twitter was worth 44 billion. It's, you know, it's probably going to take a disproportionate amount of Elon Musk's time when maybe he should be focused on Tesla. He says, investors are still looking for 40 to 50% growth for the next decade, which pretty much means Tesla is going to be the entire car industry by the 2030s, which is kind of ridiculous, right? That's probably not going to happen. And that's what Chanos says exactly. So, oh, and then ride delivering services. I didn't know this, but he also talks about Uber and DoorDash. These companies have been around for like 15 years and they still have yet to figure out how to be profitable, which that's, you know, I mean, Amazon, it took about 17 years, I think. Some of these companies, it takes a while, but 15 years? Whew. Speaking of Sam Bankman-Fried, by the way, I mean, you really can't make this up, but he is speaking at a New York Times event. I wanted to mention this again in this video. He's speaking at a New York Times event. I believe it's coming up like this week or next week. He'll be speaking via video call, right, from the Bahamas, of course, because he's probably worried about stepping foot in the United States. But he'll be speaking alongside Janet Yellen and Larry Fink of BlackRock. You know, so it's going to be all these guys trying to convince us that they're not trying to screw us over, right? That they're doing something good. All of them. It should be funny. It should be real funny. A soaring US dollar will force the Fed to pivot away from interest rate hikes but that won't be enough to prevent an earnings recession, says Morgan Stanley. And remember, we talked about, I think it was Andrew Sheets from Morgan Stanley in a couple videos back. What was he saying? That there was going to be a 50% basis point rate hike in December. So we're hearing this from Morgan Stanley, we're hearing this from the banks, we're hearing this from the mainstream media. 50 basis points in December. And I just keep thinking, why 50 basis points? Why not another 75 basis points? The European Central Bank on December 15th is raising interest rates. I forgot what the date is here in the United States, but it's probably around that same time. So the interest rates in the EU, right, the European Central Bank will be raising them on the 15th. And what analysts are saying is that it will be between 50 and 75 basis points for the ECB. And I'm not sure how many 75 basis point rate hikes they've done off the top of my head, but it just seems to me if the ECB could raise by 75 basis points, it's possible the Fed could raise by 75 basis points again. I mean, I think it's possible, but maybe I haven't been in this game long enough to realize any differently. Morgan Stanley also talking about global US dollar liquidity being in the danger zone. Stock investors shouldn't be too excited by any Fed pivot because an earning recession is imminent. And Morgan Stanley talks about how even if the Fed pivots in December, what they've already done to the markets with their interest rate hikes, we're going to start seeing that in the earnings next year. And I've talked about this delayed effect where the interest rate hikes from August, maybe even July, are just kind of, the effects are really just starting to hit other markets besides the stock market. The stock market can tend to react very quickly, but other markets like housing markets and credit markets, consumer markets, all this kind of thing, there's a lag, right? There is a lag of a few weeks, a few months. They talk about the Bank of England having to intervene by purchasing the long-dated bonds, to stem the gilt, which is their bond, to extend or to stem the soaring yield on their gilt. The Morgan Stanley is claiming the Fed is likely going to have to do the same thing. In fact, there was one headline where they were basically calling for the Fed to follow in the Bank of England's, to follow in their footsteps by intervening, lowering interest rates. I don't think the Fed is going to take a lead from the UK. I mean, I just don't. I don't see that happening. Maybe I don't understand the dynamics between the Central Bank of England and the Fed. But it seems to me that if the Fed wants to raise rates, continue to raise rates at an accelerated level, like 75 basis points, the Fed is going to do that. I've said this time and time again, until people are banging on the doors of the Fed and breaking windows like it's January 6th. I don't think the Fed really cares what their interest rate hikes do to the economy. They may not really care what it does to the global economy, as long as they claim, get closer to their 2% average inflation target over, a period of decades, if not 100 years or more. You got to remember, the central banks, these are the central planners of the world. They're thinking decades, if not hundreds of years into the future. Whereas like you and I, most people, we're focusing on the day-to-day drama between the left and the right, and, a lot of this stuff that really just doesn't matter. So, you also had a pause in Polish interest rate hikes, all right, and supposedly that's going to continue as well. So we will see. I mean, it's just when the media is telling me one thing, they're telling me 50 basis points. We've been hearing this for a long time now, right? Since we've been hearing this for like 2 weeks at least, right? Right after they came out with their 75 basis point rate hike. We just started in November. We started hearing these 50 basis point rate hike claims. ECB sees smaller interest rate hikes in 2023 if needed. So the European Central Bank is still talking about increasing interest rates well into 2023. This is what they're talking about, and it says right here, the ECB. This is coming from Reuters. The ECB began to push up rates at its fastest pace on record in July, and markets are betting on a 50 to 75 basis point increase at the next December 15th meeting. So if the ECB raises by 75 basis points, or that could be an outcome, it definitely could be an outcome for the Federal Reserve, right? For Jerome Powell's decision here. And you can have Jim Bullard and all these Fed ghouls come out saying, oh, it's going to be 50 basis points. But I don't think Jerome Powell is that influenced by these characters they put out. I mean, Jim Bullard's basically just a loose cannon they put out there to contradict the official Fed policy or stance. And they're just trying to confuse us, right? That seems to be what the central banks are in the business of kind of confusing us, because they continue to talk about the 2% inflation target, but it's not 2%, it's a 2% average, which is so important to, once you realize that fundamental difference, it's like, well, an average over what? Over how many years? That's the question that I can't figure out. All right. Last story is marijuana sales in Virginia Beach, where I live, right? They're starting to legalize marijuana. Right now, you have to have a medical card, but you can buy Delta 8 and other variations of THC. And soon, the liberals, the leftists here in Virginia Beach, they want you to be able to buy marijuana on the boardwalk, smoke marijuana in front of families. I mean, it's getting crazy. They're trying to turn this place into Santa Monica or Venice Beach. So it says, after state legislators loosened regulations on marijuana last year, city leaders are trying to get in front of any further changes to the law. Essentially, you have business owners here in Virginia Beach that are extremely concerned about selling more and more marijuana here in Virginia Beach. They say that, maybe perhaps with certain limitations and considerations, we could go through with retail marijuana sales, but the General Assembly didn't pass proposed legislation needed to create a marijuana retail market, but it may revisit the issue in the 2023 session, which begins in January. So if they legalize the marijuana, then different towns and cities will have to choose to allow these, marijuana shops they'll have to enact zoning laws and everything to control them. So illicit cannabis consumption and sales have been a source of frustration for some Virginia Beach tourism industry leaders. And like I said, they're concerned about, the marijuana odor coming from, it says right here, they express concerns about marijuana odor wafting from hotel balconies and pop-up shots unfolding at the oceanfront. It is also not uncommon to see people brazenly smoking weed on the boardwalk. They've also questioned the potential impact legalized sales could have on the family-friendly resort area. And it is a family-friendly resort area. This is a place where people come to relax. This is a place where people come to vacation. And if you turn it into, another Venice Beach or Santa Monica, and you just have marijuana sales on every block down there, and people are just smoking marijuana on the boardwalk, we're going to lose something for sure. And listen, I like to partake, right, in cannabis, but I don't like the idea of turning the entire boardwalk, entire Virginia Beach area into a haven for heathenism, drug addiction. We don't know what kind of people it will attract, because people already come here to have a good time, to visit some of the restaurants and the bars down there. And if we have people coming to Virginia Beach because it's easier to buy marijuana than where it is wherever they come from, you're going to attract all kinds of people to this town, and probably not for the same reasons that a lot of people are coming here for. People want to keep this a family-friendly type of town. And if you turn it into another Venice Beach or a Santa Monica or a West Coast, it's concerning. It's concerning to see how far they want to take all this, right? It's not enough that you can't be arrested anymore for, buying marijuana, or I think you can have up to 3 ounces in Virginia. You can have like 4 pot plants. And even though you can't buy it recreationally, right? It's been decriminalized. People are not going to jail for it. But the left, the Democrats, they want to push this as far as they possibly can. And, the goal is really the globalists They want the average American to smoke marijuana and forget about their political problems, forget about their spiritual issues, and just rely. You know, it's just another form of escapism that the global elite, using, you know, the Democrats and a lot of front groups, they're using that as a way to push more and more cannabis use. That's my opinion. And so the result is, even in your local area, maybe in your local city, you're seeing big moves to push for you know, more and more marijuana shops on city blocks that, you know, you have to walk every single day. And is it a good thing? Probably not. You know, is it God's will? Who knows God's will? But we will have to, I suppose we'll all have to pray on that one, right? Because it's like you have your personal choice, right? Or maybe your personal habits, your own sins, but it doesn't mean you want the rest of the world to follow suit, if that makes sense. So I hope you guys enjoyed the video. Comment down below what you think about the interest rates, the inflation, the Fed pivot. I mean, is any of this stuff actually real? What do you think about Morgan Stanley's call for a 50 basis point rate hike in December, calling for the earnings recession? They come up with all these new terms. Remember when I was talking about the 2-word doublespeak in the previous video? Well, earnings recession, right? Well, what does that mean exactly? They're changing the definition of recession. When we hit the definition of recession, which I think is 2 consecutive quarters where the GDP is slowing. You know, we had hit that. I think the last GDP numbers came out better, but we did hit that, and they said, oh, it's not a true recession because, and then they just come up with some reason. So they're constantly changing the goalposts. So look out for that as well. And with that, I hope you guys enjoy the rest of your day. Please follow me on Instagram at Millennial Trades. I'm also on Twitter. And with that, I will see you guys on the next video.